Hello, Professor Castagne. Today for our audit memo project, we decided to choose Target as our company. So a little background on the business and operations of the company. Target is a retail corporation that sells a variety of merchandise from household items, groceries, apparel, electronics, and more. Through a network of physical stores and a large online platform, Target gives their customers the ability to shop from home or in person. They make their sales through physical stores and their e-commerce website. They sell different items from different manufacturers at different price points, and in general, Target sells their own brand items at the most inexpensive price. So they have pretty much items that everyone's familiar with from different brands, but they want people to buy the Target one, so they make it the cheapest. Overall, the business model revolves around offering a range of products at varying quantities at varying prices and qualities. Because of this, Target has the ability to adapt to customer preferences due to the fact that they have many brands and pretty much sell the same thing. Target has identified many risks. Now moving on to the risk factors of Target. They identify a lot of risk in their risk factor section and the MD&A sections of their 10K. In regards to risk factor, Target splits their sections into competitive investment, IT tech, supply chain, third party, legal, and financial risks. The most concerning risks that I saw in the 10K is the competitive risks. Target states that they need to successfully develop, source, and market their own exclusive brand products, which is what I mentioned earlier. And I chose to highlight this risk because I'm just kind of curious to see how much it impacts Target's overall sales. Is it a lot from the Target brand? Is it a lot from other brands, etc.? The risks from the MD&A section are sparse, but the one that we noted that was the most risky was the sale of Dermstore LLC. It seems to have impacted the way we view the year-to-year consolidated financial statements. I'd also like to note that in the critical audit matters section, it is difficult to audit all the inventory of Target just because it's so large and there's so many of them. And it's very difficult to audit the third-party vendor income that Target receives. In regards to setting materiality, we selected the income before taxes as our base. This is because Target's a profit-oriented company that has income that is stable, predictable, and representative of the entity's size and complexity. It is also the preferred base for most materialities. We also determined that the key ratios for this industry are the current ratio, quick ratio, the gross profit margin, the inventory turnover ratio, the ROA, the interest coverage ratio, and the EBIT margin. We decided to compare Target to its largest competitor, Walmart. Pretty much most of them looked very similar. The only differences were in inventory turnover, which Target's was 6.09 and Walmart's was 8.20. The interest coverage ratio, Target's was 9.9 and Walmart's was 15.5. And the EBIT margin, in which Target's was 7.4 while Walmart's was 4.1. Something that I did want to really note that I mentioned earlier is the sale of Dermstore LLC. This is a major change to Target experience. They sold it for $356 million in cash and recognized a $335 million pre-gain tax, which went to their income. Dermstore was 1% of the consolidated revenue, operating income, and net assets. Another thing I wanted to note is that in current events, Target had some slight controversy when selling LGBTQ plus merchandise in their stores. I kind of was curious about this because it was a big thing in the news during the Pride Month, so I looked at their Q2 sales, and it didn't seem to really impact them. I didn't really see a significant difference between like the last year's Q2 sales or the Q3 sales. And however, I feel like this kind of really polarized Target's customer base. Some love what they did, some dislike what they did, which kind of just generally impacted the public perception of Target. And earlier, Target mentioned that in their risk factors, that this was a big thing, the public perception of Target. I feel that Target handled the situation efficiently as they outlined this risk in the public perception in their risk factors. By now, I don't know, I kind of forgot about it until I Googled things that happened to Target. And yeah, that's pretty much all I have for you. Thank you. Passing it off to Aiden.
I'd like to touch on specific significant accounts on Target's balance sheet and income statement that caught our eye, as well as identify which assertions will have the highest inherent risk for each of them. Starting on the balance sheet, I'd like to analyze the cash and short-term investments account. Looking at the ending balances from the last 5 years, the cash and short-term investments account was down 30.55% in 2022 and now 62.29% thus far in 2023. The assertion that will have the highest inherent risk is valuation and allocation, which poses the question, are the amounts presented in the financial statements fairly stated and appropriately classified? There may be uncertainties or challenges in accurately valuing these assets because of changes in market conditions. Also, there may be concern about appropriate allocation of these amounts because allocation of cash between different categories requires careful consideration. Next, I'd like to take a closer look at the short-term debt account. Once again, looking at the ending balances from the last 5 years, this account stayed steady around the $200 million mark from 2019 to 2022 and skyrocketed to $1,896 million in 2023. The assertion posing the highest inherent risk here is accuracy, because it questions if the amounts and other data relating to recorded transactions and events are recorded appropriately, and are the related disclosures appropriately measured and described. Target can potentially be overestimating their short-term debt in order to enhance their credibility to stakeholders. This shows that they have a clear understanding of their financial obligations and are able to pay their stakeholders. Switching over to Target's income statement, there are a couple more accounts I want to dive deeper into, starting with sales. Although sales growth has been on a downward trend over the last few years, it always has a high audit risk because it is the most crucial factor in determining a company's financial performance and position. The assertion with the highest inherent risk here is occurrence, which refers to the transactions and events that have been recorded or disclosed, occurred, and do such transactions and events pertain to the entity. Fictitious sales are common because they can create a better appearance of the company's financial performance, allow employees to reach bonus quotas, cover up frauds, influence stock price, or even satisfy pressure from stakeholders. The next account in the income statement we want to take a second look at is net income. There was a steady gradual increase from 2019 to 2022, and then all of a sudden an exponential decrease of 119% in 2023. Although this is probably fairly inaccurately presented, we are going to refer to the completeness assertion to make sure that all transactions and events that should have been recorded have been recorded, and all related disclosures that should have been included in the financial statements have been included. Companies such as Target may underestimate net income in order to reduce its taxable income, therefore lowering its tax liability. There can potentially be fraud being performed by executives in the company trying to lower stock prices and key financial ratios in order to have an exponential increase in the following year. Being in the general merchandise industry, there are specific accounting and auditing problems that arise. Starting with inventory from the accounting perspective, the choice of inventory costing method, like FIFO, LIFO, or weighted average, is crucial as it can affect COGS, inventory cost, gross margin, net income, etc. The auditing issue associated with that is that auditors need to assess the appropriateness of the method chosen to ensure that their clients' alignment with accounting standards and industry norms. Next, looking at revenue recognition from the accounting side, it deals with complex sales agreements, discounts, loyalty programs, revenue at the point of sale, and gift card liabilities. Auditors then need to examine their clients' revenue recognition policies, assess accuracy of reported sales, and ensure compliance with accounting standards. Leases pose a couple issues as well because there are new lease accounting standards, ASC 842, that include major implications for retailers leasing store locations. So, the lease liabilities and right-of-use assets must be reorganized, and the auditors must review these lease agreements, assess accuracy of these lease calculations, and ensure compliance with new accounting standards. Employee benefit plans create issues for retailers as well because oftentimes retailers offer retirement plans and health benefits, which involve estimating future obligations and expenses. In turn, the auditors have to review these calculations of pension and post-employment benefits. There has been a drastic increase in reliance on e-commerce and digital platforms, which raises concerns about cybersecurity and data privacy, as well as the costs associated with that. Then auditors come into play and assess the effectiveness of the internal controls related to data security and provisions for potential liabilities and cybersecurity costs. Lastly, sales returns and allowances from the accounting perspective generate issues because companies have to estimate these specific amounts of returns and allowances as it is crucial for proper revenue recognition. The auditors then have to assess this estimation process, review management assumptions related to returns and allowances, and make sure they properly align with the revenue recognition standards.
So, I am specifically going to discuss the pressure management phases to meet certain earnings targets. This analysis is crucial for understanding the company's strategic decisions and their impact on financial reporting. First, let's look at the company's investment and cost-saving plans. The company plans to invest between $4 billion and $5 billion, indicating significant growth and expansion ambitions. Simultaneously, they are targeting $2 to $3 billion in cost savings over the next few years. This ambitious balance between growth and efficiency sets a challenging backdrop for management. Moving on to sales and revenue trends. We observed a decline in discretionary categories. However, the company's operating income in Q3 was 28.9% higher than the prior year. Despite these revenue challenges, this indicates effective cost control, which is likely a response to meet profitability targets. Next, focusing on financial performance. The company reported an adjusted earnings per share of $2.1 in Q3, which is a significant increase from the $1.54 in Q3 in 2022. This growth in earnings per share suggests a strong emphasis on maintaining profitability. Additionally, the projected EPS for Q4 ranges from $1.9 to $2.6, reflecting the targets that management is aiming to achieve. A critical aspect to consider is the compensation and incentive structures. The short-term incentive plan directly ties executive compensation to sales and operating income. For example, in the fiscal year of 2022, the company's actual sales and operating income fell short of the goals, leading to reduced executive payouts. This directly links management's financial benefits to the company's performance, adding considerable pressure to meet specific financial targets. In conclusion, the combination of substantial investment plans, significant cost savings targets, and the direct link between executive compensation and financial performance metrics indicate that there is indeed considerable pressure on the company's management to meet specific earnings targets in 2023. These factors shape the company's strategic decisions and have implications for both financial reporting and auditing perspectives.